Okay, so in that context, what we are advising is that 2026 accrual or carry or search for yield might be the theme, which will actually be the right criteria for investors also, and somewhere down the line from a market perspective also. So we believe in 2026 accrual as a theme in an environment where there are no rate hikes, no rate cuts, very significant lower inflation, and a pause for most part of the year. I think accrual as a theme will work very, very well.
Okay, so this is all about India. Now let's talk about global. Where do you see policy heading globally across economies, and any significant changes, and those will they impact India also? Hello investors, welcome to Moneynomics by Axis Mutual Fund. I'm Shalini Gautam and I have with me Head of Fixed Income, Devang Shah. So let's today, Devang, take a step back as we head into 2026. Just step back and recap what happened in 2025, how this entire 2025 has played out in terms of the macro environment, and then how we expect it to play out going forward. And also let's discuss about how global policy is headed and what will be the way forward for it. So now let's begin with how have the bond markets shaped up in 2025.
Well, thanks, Shalini. And as you rightly pointed out, this is a crucial time. We are all in December, and probably now the thought process should shape up around what should be in investors for bond market specifically for 2026. But if I do a quick recap of 2025, I think first of all, it is important to understand that when we were entering 2025, what was the macro scenario then? Okay, important point was we were in a significantly tighter liquidity environment. Similar phase where people are worried about too much of currency. We have in massive intervention in rupee, and liquidity got very, very tight. Similarly, credit growth was quite weak. Okay, and RBI was all in for ensuring positive credit growth. RBI did a plethora of measures, which was starting with liquidity infusion. Last year, same point of time, they did the first CRR cut in December, and then we saw huge amount of liquidity infusion and rate cuts. But the macro dynamics actually supported the entire lowering of rates and this entire influx of liquidity. Let's look at the overall growth phase. Like first 2 quarters, we saw the growth numbers, which was Q3, Q4 for last year, were very, very weak.
Yeah.
Which led RBI to cut rates to support the growth environment. Secondly, what happened is inflation. The inflation actually came to a significant surprise to all of us. Like we were in our best case assuming inflation to be like, obviously it was lower than RBI's threshold. We were all talking about, but did we anticipate that inflation will be as low as 2% or 2.5% for the full year? I think no. So inflation came as a significant positive surprise. It was thanks to all the good sowing, positive rainfall. We got benefits on account of crude. But I think that somewhere down the line, the reasons for RBI to be so dovish for this entire year has been a weaker than anticipated growth for the first 2 quarters. And secondly, for the full year, a significant lower inflation. What happened to bond markets? I think bond markets were significantly happy with the steps which RBI took. So you had rate cuts, you had liquidity, you had OMOs. So that led to significant rally if you look at the first 2 quarters. The first 2 quarters from calendar year 2025, from Jan to June, we saw yields completely collapsing by 50-60 basis across the curve. But after June, markets started getting worried about 2 or 3 aspects. One was what's happened on the trade deal, what will be the outcome of the trade deal. Secondly, how will the fiscal balance shape up? And then we had this demand-supply imbalances and long bonds. So if you look at the second half of the year, the curve actually started getting steeper. So the first half of the year, we saw complete collapse in bond market yields. Everywhere there was a rally in bond markets from be it 30-year, 1 year, 10-year GSEC, or even the short end of the curve. But after June, when markets started sniffing that we are at the fag end of the rate cycle, probably there will be demand-supply imbalance for government bonds or long bonds, and somewhere down the line tariff concerns which can lead to fiscal impulse. I think the curve started behaving separately. The long bonds didn't perform, the short end continued to perform. Where we are today, I think if I look at 2025, I think the short to medium term assets did very, very well and the curve got steeper. So like 2024 was a complete play for duration. I think 2025, if I sum it up, it was a complete play on liquidity, which led to the curve getting steeper, and short end behaved very well throughout the year. I think long bonds had a patchy year where beginning of the year they did very well, but second half they didn't do so well.
Okay. I do remember we have brought out a lot of acumen on liquidity and tactical, taking tactical plays in our long bonds and stuff. So now, Devang, where do you think, now we are not in the duration segment anymore. We are talking about, moving into accrual. Could you elaborate a bit on that?
So see, how I look at it is, and probably I'll add to what's there in the policy context also, because it is important. We have seen a very, very dovish policy from RBI, and I think RBI has again remained all out supportive to growth. So if I probably cover the policy outlook and then the way forward for 2026, which is our theme, where we believe that accrual will make a lot of sense. I think, first of all, policy gave some space for rate cuts, and the reason was somewhere down the line the lower inflation. Growth can see some bit of headwinds on account of tariff uncertainty. So our view is, today, I think RBI has been very, very bold, and somewhere down the line, the thought process for RBI is very clear that they want to be growth supportive in an environment where we are seeing currency depreciation. The reason being, our understanding is the currency is under somewhat of pain today, and there has been some currency depreciation is on account of the issues around trade deal. It's on account of higher trade deficits, which I think monetary policy will not be able to adjust. When they look at the other two aspects, which is growth and inflation dynamics, I think the year forward inflation expectation still continues to remain around 4.5%. If you have seen RBI's policy document, they have actually given the forward-looking inflation. We are talking about the first half inflation to be below 4%. So that is the reason why I think RBI chose to support growth and delivered a rate cut. Now getting into next year, our perspective is that rate cuts will be very, very limited. If you ask me, I think we are done largely with the rate cuts, unless until we see a big shock on the growth side. I would say rate cut from here will be very limited. But rates are going to stay lower for longer. In fact, we released a note in August also about the long bonds rally largely getting done. But the rates will continue to remain lower for longer is our view. Because the inflation outlook is such that I think for the entire year, inflation doesn't go above 4.5. If that is the context, I think repo rate in India will settle between 5.25. So our view is, in an environment where growth remains patchy, inflation significantly under control, I think RBI will remain on a pause for 2026. Now, in an environment where you are not going to see too much of action from RBI, and I had used this term in the last video also when we are done, that bond markets can actually be boring for some point of time. And I believe that in 2026, you will not see too many actions. Okay, so in that context, what we are advising is that 2026, accrual or carry or search for yield might be the theme, which will actually be the right criteria for investors also, and somewhere down the line from a market perspective also. So we believe in 2026, accrual as a theme in an environment where there are no rate hikes, no rate cuts, very significant lower inflation and a pause for most part of the year. I think accrual as a theme will work very, very well.
Okay. So this is all about India. Now let's talk about global. Where do you see policy heading globally across economies, and any significant changes, and those, will they impact India also?
See, so good question, Shalini, because I think we have always looked at the correlation, what happens to global markets, and then probably the impact of that. In various acumens, we have already said that that correlation is now not as strong as it was before. We have seen a lot of correlation being broken, but specifically when talked about other markets, we believe that the pace of rate cuts now next year, like if you look at 2023, 24, 25, or largely 2024, 25, we have seen rate cuts everywhere. Okay, I think the pace of rate cuts going ahead in global economies also will be significantly lower. Our assessment is that probably Fed might do a cut in this December policy, but it might sound as an hawkish cut, and incremental space from Fed also will be very, very limited. I think again when you talk about European central banks, except I think Japan central bank is already on the way to hike rates.
Yes.
European central banks also might not be, ECB also might not be able to cut much more from here. So our perspective is that 2026 is a year where large part of the central banks, including Fed, we will not expect too much of rate cuts. So our view is that probably Fed will at max cut 2 more rate cuts in the year 2026 and take the Fed fund rate in the band of 3.25 to 3.5. Again, when it comes to Japanese central bank, we don't expect too many hikes, but there is a possibility of a 50 basis hike there. So I think from a global macro backdrop perspective also, we don't anticipate too many rate cuts and we don't anticipate it impacting our bond market significantly.
Okay. You've already mentioned about accrual, but if as an investor, how should they look at investing across the curve?
So we have always been talking about that investors need to understand their investment horizon. And again, I'll repeat the same thing, that if an investor is he's finding out a parking solution, investors should look at in an environment where there are no rate cut, rate hikes, liquidity is going to remain comfortable. And I'll echo the sentiment. I think RBI has been all out and supportive markets on the liquidity front. So we believe that RBI will continue to provide liquidity. So if an investor is looking for a parking solution, we continue to advise a money market solution like a money market fund or ultra short term fund. If an investor is a medium term debt investor, we continue to advise an income plus arbitrage category for them. If an investor is tactical, and I'll just tell you why there are some tactical opportunities in bond market. So bond markets, large part of 2026 will remain boring, but we might see our bonds getting added in Bloomberg indices and the global, and we've been talking about it. So if that happens, and that can happen in the first quarter or next calendar year, so if that happens, we might see some tactical opportunities in long bonds and gilts. So I think if, depending on the investment horizon and the type of investor, I would say a money market solution for a parking investment advice, income plus R for a medium term debt allocation who is looking at a tax efficient solution, a medium term or a corporate debt fund for capturing the accrual trade, and gilt for capturing those tactical opportunities if our bonds get added in Bloomberg Index.
Okay. Thank you, Devang, for your valuable insights, and thank you to our investors. Stay tuned to Moneynomics by Axis Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.